Hello and welcome everybody. Happy Friday, welcome to another Sectors Made Simple webinar. Today, we're coming back to the topic of energy and how the Russia-Ukraine war has affected the sector. There's been a lot of things that have been going on with the sector, some profitable, some not profitable, but all around risky. So today, I want to highlight exactly that. I want to talk about the energy sector, not just in the past 2 weeks, but in the past year, so that we can look at what's happened, what's happening, and I'm not going to guess at what happens next. Instead, I'm going to give us the information we have today, and then let you decide what you think is going to happen next. So, let's get straight into the topic, shall we? Quick disclaimer, you can't see my screen. There we go. Quick disclaimer, today we're going to talk quite a bit about historical returns, historical events, and also current events. At no point in any of this should this be constituted as financial advice. I will go over and over to say, hey, we don't know what's happening. There is no flip to this page when there's a global conflict that involves one of the world's largest exporting oil countries. There's no rule book for what to expect when that happens. So because of that, we can't predict what's about to happen. We need to live it. So please take this as educational resources. I've done my research to try and understand what's happening and try and predict what might happen, but I encourage you to do your own research, take today as a piece of information, and learn alongside us. So the goals for today's webinar is pretty simple. By the way, I apologize if I'm kind of talking weird. I accidentally bit my lip, so I have a little bit of a weird cadence to my sentences. But goal for today, pretty straightforward. Energy has been a leading sector throughout most of 2021. And today, March 4th of 2022, it remains as the strongest sector in terms of relative strength. If we pull up the relative strength matrix, brought to you by Sectors Made Simple, not a sponsor, but it's us, so definitely a sponsor. If you look at the total count for our matrix, we see energy is clear and away the strongest sector. It holds relative strength short-term and long-term over every single other sector. And not just today. 1 week, it's gained quite a bit. 2 weeks, it has already been strong. It is not that it just rose out of nowhere. It's been a leader for quite a while. But this sector has also experienced a lot of volatility. And as oil and gas is constantly flipping price right now, as well as uranium is something we're also going to talk a lot about today. These companies are bouncing between huge gains, huge losses, and a lot of uncertainty about what the next move is going to be. So today, we're going to take a look at energy throughout 2021, and we'll also talk about where energy is today, and share some thoughts about where it might be headed in the coming weeks, months, and even up to a year. So let's start off with some basics about energy. And I want to talk here about the sector XLE, the sector ETF, that is, XLE. So XLE has 23 holdings within it, a dividend yield of 3.44%, and the top 5 holdings are ExxonMobil, Chevron, EOG, Schlumberger, and ConocoPhillips. The names aren't as important as what I'm about to say. The top 10 companies out of these 23 make up 76% of the performance of its sector. Oil and natural gas dominate XLE. They're not the only things, though, in XLE. XLE includes uranium companies, but they're not in the top 10, and they are not the reason that energy succeeds or fails. So I want to highlight exactly that by showing you this. In the New York Stock Exchange, there is a total of 191 energy companies. And that is what we're going to focus on today. Before we do, I want to make sure we know exactly what is and isn't considered part of energy. So the energy sector is made up of companies that are involved in the discovery, so finding where the oil is, extraction, taking the oil, sucking it out of the ground. Funny enough, sometimes to store oil, they'll stick it back in the ground. Go figure. They spend a bunch of time and money getting it out just to stick it back in there to store it. But I digress. Then, once they've extracted it, they need to refine the oil into usable things for gas, for utilities, so for power generation or heat, for anything. They need to turn it from something they pull out of the ground to something you can put in your car or put in a water heater. And this applies to many things. Finding it, pulling it out of the ground, and turning it into something we can use. Because it's not just for oil. It is also for natural gas, for coal, and, yes, for uranium as well. Now, if you noticed, I did not say a couple of other, well, three really, other categories that are considered energy. These other three renewable energy sources are solar, wind, and hydroelectric. Literally water. So when we're talking today about energy, I'm only using the classification or kind of the groupings that FinViz uses, just so that we all have the same source, we can all look at the same numbers, and if you want to take what I talk about today and continue learning from it, I want you to know where this information comes from. So we will be looking at FinViz companies today, or what FinViz classifies as energy companies. Hydroelectric and wind are not part of the energy sector. They are under utilities. Solar is not part of energy. It is under technology. And yes, uranium is under energy. These are our clean energy sources. But when we're talking about the energy sector, energy does not, the energy sector as we look at for XLE, but also FinViz looks at, excludes these renewable sources. Wind is renewable. Solar is renewable. Water, pretty much renewable. Uranium, not renewable, but clean. Oil, gas, coal, definitely not clean and definitely not renewable. So that's the distinction that is usually made here. So I'm going to stop talking about the technicalities and that this is and that isn't. Let's go down to something that we all can relate to and makes sense to all of us. Prices. Let's just cut to the chase and go look at the prices, shall we? So, ta-da! These are the prices of energy. Up at the top, which is right here, we see XLE, the S&P 500 ETF for energy, and what its returns have been. The data I pulled today, so anything you see here is as of today, as of market close today. We see energy has gone up by almost 10% in 1 week, 10.6% rounded up in 2 weeks, 9% 1 month, 34% 3 months, 55% 6 months, and 47% 1 year. For those that are Sectors Made Simple subscribers, you will have access to this as well, but for those that aren't, I did want to show you the full extent of what you can find with energy. In our Sectors Made Simple investment resources, we have a signal lookup industries. This lets you look up any sector ETF and see how the subsectors within that industry are doing. So if we type in XLE, we get the results for XLE, for the energy sector. So that is where this data I'm about to show comes from. We see thermal coal is, by and large, the most successful industry within energy, with the best returns yesterday, past week, past month, past quarter, second best for past 6 months, best year to date, and holy cow, over triple its value in the past year. That's a lot of price changes. But looking beyond that, every single sector, or industry, my apologies, within energy has exploded in the past year, with oil and gas, and even to a certain extent uranium, doing pretty well in the past month to 2 months. And there's a lot of reasons why. So I want to start now by going back. And by back, I mean, let's go 1 year ago. Let's go 2 years ago. Let's start with 2 years ago. There was a time that oil manufacturers and oil suppliers would have paid you to take oil off their hands. Sounds crazy that you would get paid to get something, but that was where we were at in the world. At the time, there was this new pandemic, the world going into lockdown thing around some virus that happened. And as a result, manufacturing halted, transportation non-existent. The global demand for oil plummeted. People didn't need oil as much anymore. But supply chain can't just stop. It's got some momentum and it keeps pushing. On April 20th of 2020, we saw this hit its peak, or really its bottom, where oil futures, which is how oil is usually sold. What will happen is you don't buy a barrel of oil today. You say, hey, I promise I will buy a barrel of oil from you 1 month from now for this price. Those I will buy it in the future for this price were negative. Meaning, you could say, I will get a barrel of oil from you next month and you will pay me $50 for that barrel of oil. So you get a barrel of oil and money because they had nowhere to store it. Oil suppliers were sticking it back in the ground and running out of space. So they started sticking it on boats, and then they ran out of space. Then they started sticking it in warehouses, and they ran out of space. So they started giving it away. They started paying people to take it, so they didn't have to store it. Obviously, paying people for something that you also had to pay for is not very good business. So the oil industry didn't like this and wanted to stop this from happening again in the future. So OPEC, the Organization of Petroleum Exporting Countries, they decided they're going to cut how much oil they were manufacturing and they were supplying to the world. Now, they're not the only ones, we are the market, but OPEC is a really good group for us to look at because it does account for 40% of the world's crude oil supply. So when OPEC says jump, the industry does jump. So we can use OPEC as an easy way to track what's changing in the oil industry. So OPEC said, we messed up, the world doesn't need as much oil anymore, and we're losing money. So they said, okay, we're not going to give you as much oil anymore. There's this idea of supply and demand. Here's supply, here's demand. When the supply stays the same, but demand goes down, the price goes down. Because there's not as many people needing to buy, but there's still the same amount of people trying to sell. So what OPEC did was they lowered the supply so that we're back on the same level. But they didn't just lower it. They tanked it. They lowered their production significantly. So when demand returned, OPEC, remembering that they were just paying people to take oil, decided, nuh-uh, we're not going to increase our production. We're going to keep it low. Well, they did increase it a little bit, but not nearly as much as they needed to in order to actually keep prices flat. So May 2021 was the first time in 2021 that OPEC actually increased how much oil they exported. But they increased it a little bit. Demand increased a lot of it. If you're curious to see exactly how much, OPEC does publish, let me see if I can find it, they publish a monthly report of how much oil the world was in need of. And it's really interesting because it shows us exactly how much the demand increased. Now, I'm not going to bore us with all the details of that, but if you are curious, I did link OPEC's website with all their charts and graphs, where they do offer those publications for free. I read through it to make this presentation. There's a lot of information in there, not all of it's useful. But they do have a graph in there that shows how much oil demand increased. So they know how much oil we needed, and they produced just a little bit less so that the price of oil would go up. And boy, did it go up. The price of oil skyrocketed. So when the price of oil skyrocketed, OPEC, of course, would start producing more, right? They'd try and meet that new demand. I wish they did that. Demand for oil increased far faster than the supply did. So oil prices continued to go up. When oil prices go up, utility costs go up. Gas prices, when you go to fill up your car, go up. And that is not something that is caused in a matter of months or a matter of weeks or even a matter of a year. This is years in the making that these oil prices are skyrocketing. But when people start having to pay more, it makes us have to ask a question. What's our other choice? Do we have another option? If you could say, well, my electricity bill went up. Can I get solar? Can I get a wind turbine? Can I get my exercise with a giant hamster ball in the backyard? Anything to get that electricity bill lower, right? That's how you might think for your house, but governments think the same way. Nations think the same way. Companies think the same way. Can they make money or save money with something else? Can you save 15% or more by switching to uranium? Well, that's exactly what the energy industry tried to do. So began the rise of uranium in 2021. So let's take a look at uranium in 2021. Remember, the energy sector, as Finviz describes it, is non-renewable energy sources. Coal, oil, gas, but also uranium. So when companies and nations wanted to start moving away or reducing their oil need, they started looking to uranium as an easy solution for it. Between September 2nd of 2021 and November 12th, hey, my birthday, of 2021, the uranium ETF, just to give a price that we can follow, the price of the uranium ETF UU went up by 81.35%. Let me show you what that looks like when we look at an actual chart. So to make this as clear as I could, what I did was I created a chart out of UUUU, the uranium ETF, XLE, which is just energy, the S&P 500 energy, XOP, which is oil and gas exploration, Illyrian MLP, which is AMLP. They are involved in equipment and services. And then Van Eck Oil Refiners. As the name says, they do refining for oil. What we see now is, and let me make this actually be a thing. Let's make this graph be 2021. The red line that we see, that is uranium. It exploded between September and November of 2021. It was a leader throughout a lot of 2021, but its meteoric rise occurred between September and November of this year. We see energy somewhere in the middle of the pack. Then we see exploration above that, and way below, equipment and refining. So let's now narrow this down to September. One more. Too far. There we go. This now is looking starting at September 2nd and ending at the end of the year. And I don't think I need to say too much that uranium saw a huge rise. So that was the result of companies and countries realizing that they can't just rely on uranium. At the same time, many countries that used coal as a primary source of energy and heating started to run out. China and India almost ran out of coal. And that is huge. So, as a result of that as well, the demand for uranium went up. And again, we're talking an order of over 81%, or just about 81%. So, did it stay up there though? Was this the new rise of the booming industry that is uranium? Nah. Just as quickly as it rose, it fell once again. And by January of 2022, if we look at the chart, it crossed over, falling below energy, and actually losing the entirety of what it gained through September to November. Just about towards the last week of January. Uranium's gains gone. Why? Why did we see an industry grow, almost double its size in 2 months, and then in the following 2 months, erase all of its profits? Well, we can't be 100% certain. There's a lot of different reasons, but I'm just going to show 2 of the main reasons. One of them is Russia's increased aggression in Eastern Europe. Russia started to get heavily involved in Eastern European politics, primarily with Ukraine, but also increasing tensions with Kazakhstan. And I'll come back to that one in a moment. Another one of the reasons that we saw a huge rise in price was that in the winter, we saw some really cold months and some really big countries running out of coal. That really should not come as much of a surprise, given what we saw here, with coal skyrocketing in value. A lot of that was due to companies, like domestic companies for China and India, running out of coal and relying on other countries to import coal. So that was the biggest reason that we saw uranium decline, was that oil, gas, and coal didn't just become, let's find other options. There were no other options except to increase how much they were buying and to buy at a higher price. Now, we're not going to go into 2022 just yet, because before we do, we want to actually look back at, well, actually we already did this, my apologies. We looked at all of the energy ETFs. We looked at oil and compared it to uranium and compared it to XLE, which we can use as the benchmark for the entire sector. Why didn't I show you coal? Well, here's a pretty good reason, and it's also the reason that the coal shortage happened in the first place. Coal is a dying industry. The last coal ETF, the only coal ETF, closed in December of 2020. That's the reason I can't show you how coal did compared to the other sectors, or the other industries and their ETFs. There is no coal ETF. Coal is dangerous. It is deadly for those mining it and those refining it, but sadly, it's still necessary. On a global level, coal is still necessary. Behind oil, it is Russia's #1 export to the world. And as we saw in 2021, while demand is decreasing, our dependence and need for coal, when we do need it, has not. It is an industry that we still need, is shrinking, and because the supply is going down, and for a while the demand skyrocketed, we saw the price of coal also skyrocket. This idea of demand is decreasing, but our dependence is not, applies to oil as well. Now, with all of this talked about, that was 2021. Let's now look at the past 2 months in the market, and let's look at 2022. There's a lot for us to talk about. There's oil, there's gas, there's war, there's uranium. How do we start? There's no good place to start, so I'm just going to pick one. Oil and gas. You don't need me to tell you that the price of oil and the price that you pay when you go and fill up your car has gone up significantly in the past few months, in the past year. And part of the reason is that, yes, OPEC has increased how much oil they're putting out, but demand has still increased significantly and not anywhere close to what we need. The supply is nowhere close to what we actually need for oil. And since the beginning of the year, the price of oil has gone up significantly. On January 1st, The price for a barrel of oil using Brent, so Brent crude oil is the index we're looking at, sat around $80 per barrel. Today on March 4th, Brent oil is $118 per barrel, an increase of almost 50% in 2 months. Let's go back a little bit. Earlier in this presentation, I talked about how uranium, when oil and gas become expensive, we look to uranium to be the savior. So, where's uranium in 2022? Has it taken off again? Is it the new industry leader within energy? Is it the reason that energy is booming right now? Well, let's find out. In theory, yeah, uranium should be doing extremely well. Uranium takes advantage of increased oil prices because people are more willing to switch to uranium or feel like they need more clean energy, whatever it might be. Uranium, in theory, should have taken off. And to a small extent, it did. Uranium did go up, but not for long. Because as oil and gas prices increased, yes, in theory, we would expect alternatives, such as uranium, to go up to offset the change in oil prices. But in 2022, that was not really the case. Or rather, it wasn't the case for long. Let's pull up that chart again. We are now sitting right here at the beginning of January. Just to give you a time frame, right here is where we're at. So, where did things go? Now we have to start getting into the world of politics. Because in Kazakhstan, we saw some very deadly protests happen. We saw that Kazakhstan put a limit on how much the price of oil could be. In January, they removed that limit, causing prices to skyrocket and the people of Kazakhstan to foot the bill for it. Obviously, people were not too thrilled about that, so they started protesting. Some people lost their lives in these protests, and it caused a lot of political unrest. Now, this might seem like that's just an issue that should be related to that country. That's a domestic problem, right? Well, it might seem irrelevant from a US market perspective until you have to realize that Kazakhstan is an exporter, and one of their primary exports is uranium. They export, in 2019, according to the World Nuclear Association, they exported 43% of the world's uranium. So that civil unrest caused a lot of people to panic and think, wait, uranium supply is about to go down. What do we do? And the prices tanked. Now, that was short-lived. Uranium companies stated, there's no problem with supply. We will continue to meet demand. Nothing should happen. And for a large extent, they were correct. But then, the Russia-Ukraine conflict turned hot, and war erupted. On Thursday, February 24th of 2022, Russia invaded Ukraine, sparking absolute rage across the world. Almost every single country denounced the actions by Russia. Some didn't say anything. The vast majority spoke out, stating that this wasn't okay, and immediately started to try and find ways to get back at Russia, targeting their one area of weakness, but also one of the biggest weaknesses of the Western world: oil. Russia is an oil powerhouse. In terms of just per country production, Russia sits in second place, just above Saudi Arabia, who produces oil under OPEC. Russia sits at number 2, only outproduced by the US. So, while the US does not directly rely on Russian oil, less than 10% of the US's oil comes from Russia. Many European countries do. So, how much? Like, how bad is this, where we now have to say we can't buy Russian oil anymore? Or at least that is the goal, to say no more Russian oil. For the US, it's not a hard thing to say. Less than 10% of our oil comes from Russia, so cutting out that 10% is not the end of the world. For Europe, it is, when Russia accounts for almost 44% of the EU's oil imports, and over 60% of the EU's oil is imports. That is a massive percent to lose, especially when oil prices are already going up. So let's look at this conflict and talk about how this war has impacted oil prices. First and foremost, with oil, and not just oil, also gas and coal being Russia's main exports to other countries. That's what we targeted first, and by we I mean the global community targeted first. We looked to damage Russia's economy by cutting off oil buying. Not just the ability to buy oil, but for the ability for them to receive payments for that oil. We did that by cutting off Russia from a financial communication method called SWIFT. It is how banks around the world communicate with each other, especially over borders. With Russia cut off from SWIFT, that is huge. That is like trying to go about your everyday life with no credit card, no debit card, and no ability to go to your bank to pull out money. You have the cash in your wallet, and that's it. That was the position that the world put Russia in. Now, again, we have to look at this not just from what damage does this do to Russia, but also what damage does this do to the world. And it's pretty gnarly. Part of the reason that oil is as expensive as it is right now is because of the increases in price for these commodities. Oil, natural gas, and coal. The prices have skyrocketed. But it's not just that. We have also had an increased demand for clean energy, solar, wind, and yes, uranium. So, to show this in a little bit more context and to bring all of this back together, let's now go and look at stock prices. After all, this is Sectors Made Simple. We cover investing and investment topics. Let's bring it back to our world, stock prices. And let's start off by looking at uranium, because it's the easiest place for us to start. There is a couple of things that we've seen. First and foremost, between the 22nd of February, which was right before the war started, and March 2nd, which was 2 days ago, we saw the price of uranium, again, skyrocket. To show just how big of a change that was, Let me pull up that same chart again, and I lost it. That's great. Here we go. From the 22nd of February up through the 2nd of March, we saw uranium go up over 40%. UUUU, the ETF for uranium, go up over 40%. In just 1 week, by the way. That is an absolutely staggering change. But that didn't last forever. And again, there are many reasons why a price could go down. And I'm going to just spoil it here. Yes, the price of uranium is dropping fast. Today alone, if we look at the stock price of UUUU, the stock price dropped by 7.4% today. And while it's hard to say one single reason, I can point to one very good reason, not the only reason, but a good reason that uranium has seen such a sharp drop, literally overnight. Last night, for Russia's time, afternoon and evening for the US, Russia began an assault of, I'm going to murder the pronunciation here, so I apologize, the Zaporizhzhia nuclear power plant in Ukraine. I'm going to abbreviate it ZNPP for Zaporizhzhia nuclear power plant. ZNPP. What happened here was pretty straightforward. Russia is trying to attack Ukraine and is trying to damage Ukraine's infrastructure, the things that make Ukraine or any country work. One of them is targeting energy. If cities run out of power, it becomes very difficult to live there. And ZNPP was responsible for more energy production than any other nuclear power plant in Ukraine. Russia tried to take over this power plant in an effort to cut off much of Ukraine's clean energy. But they went about it not by just waiting. They attacked the power plant. They started launching tank shells at the power plant. And for anyone that was following it live, it was scary. President Zelensky started stating that if this happens, it's going to be the death of Europe. That the nuclear fallout is going to be 3 times worse than Chernobyl, and that if that power plant has a meltdown, it's going to be the end of Europe. I'm not a nuclear expert. I do not work in a nuclear power plant, and I don't have the credentials or the knowledge to tell you if that was or wasn't true. People that are involved in the industry, many of them agree that it would have been a disaster had a meltdown happened or had radioactivity leaked out of the power plant. But the power plant was built safely and built properly. There are many layers of protection in place to make sure that doesn't happen. And the possibility of it turning into something worse than Chernobyl was very low. But that was enough to scare the world into thinking maybe uranium isn't the answer. And that is the reason that we saw UUUU and other uranium ETFs plummet today. When Russia attacks a nuclear power plant, the entire industry suffers as a result. So now, we've talked about uranium, which is only a very, very small part of energy. And for anyone that has been following energy as a sector, you can probably agree that energy is still booming. It is still the strongest overall sector. So let's finally answer the question of why. In the middle of a war around one of the world's largest oil producers, is energy skyrocketing? Let's start off by looking at companies that trade on the US exchanges. BP, Shell, ExxonMobil, those groups. Many of those countries trade with Russia. They either buy Russian oil or they have Russian oil partners that supply oil from the country. As a result of the sanctions, it wasn't just financial, it was trade as well. The international community started looking to companies to break their ties with Russia. And many companies have. One of the first of these companies was BP. BP decided enough is enough, they're not going to stand for it, and they broke ties with Gazprom, which was their Russian partner. When they did, their stock price dropped about 5%, but quickly bounced back. Since then, Exxon has also agreed to exit Russia, while Shell, they're waffling back and forth. They have reduced how much they're involved with Russia, but they have not canceled it. They are still buying Russian oil. They have not broken ties with their Russian groups. So that's where the oil giants are at. Remember, the top 10 companies in XLE are 3/4 of the revenue. It's pretty crazy to see those companies profiting from losing supply. So where have these stock prices gone? And really the price of everything in the oil industry? Up. And not just a little up, way up. Because it's simple economics. Supply is short, demand is high. That's all there is to it. As much as it would seem great to say, let's not buy Russian oil anymore. Let's go nuclear. Let's go solar. That doesn't happen overnight. Originally, Germany, one of the leaders in terms of clean energy, stated by 2050, literally 28 years from now, their goal is to be completely renewable energy. They now moved that deadline up as a result of this conflict. They didn't move it up to 2025 or 2028. 2035 is the new goal. This is not something that is going to change overnight. Demand is not something that's going to change overnight. Supply did change overnight. So where we're at right now is countries have absolutely zero choice but to decrease their reliance on Russian oil. Because any clean energy plans, be it uranium, be it solar, be it hydro, anything, takes decades to implement. So, in the meantime and in the short term, the energy ETF XLE has been rapidly increasing in price, up about 12% from last Thursday. So now, let's bring everything home and ask the question that everyone's probably wondering: is energy a strong sector to invest in right now? Well, what in the world just happened? There we go. Well, it depends on your definition of strong. And let's go into why. Energy today is in a very scary situation because it is seeing some absolutely huge profits, but for all of the wrong reasons. War and sanctions are the reason for this sector's significant increase in price. It's not that Google made an amazing announcement. It's not that Microsoft is buying Activision Blizzard. It's not a new company like Rivian has IPO'd, becoming the second largest automaker. There is war that is causing us to have to pick a side, and the side that we chose comes at the cost of oil supply. Not just for us, but for the world oil supply. That's the reason for the sector's increase in price. So is it possible that energy continues to go up? Yes. Is it likely energy is going to continue to go up in the short term? Yes. Is it going to keep going up and up and up and up? No. Is it going to keep going up and up and up at a steady rate? Definitely not. Here's why. Sanctions on Russia, like we're seeing in this war, don't have an end in sight. These sanctions were not looking at weeks or months. If this is going the way that U.S. intelligence and U.S. economists are thinking, we're going to have these sanctions for years. To give you an idea, the conflict with Cuba, in today's terms, seems like years ago. The embargo with Cuba lasted decades. And it was easier for us with that because we didn't rely on Cuba for much, but they relied on us for a lot. We have a lot of reliance as a global community on Russia, but not enough to say, well, we can't do that. We're doing it no matter what, because someone needs to stand up and say what they're doing isn't okay, and it's going to hurt financially. I personally expect these sanctions to last probably about 5 to 10 years, maybe. And especially for the short term, and even up to a year, it's going to take time for countries to dip into oil reserves or to try and stop the price of oil from skyrocketing like it has. So, to summarize things, energy is extremely risky. Take last night for an example. Uranium, the major US ETF for uranium, UU, dropped multiple percent overnight because a Ukrainian nuclear power plant was attacked. Things are not set in stone, profit is not guaranteed, and nothing is predictable. The price of oil at the moment is extremely high due to significantly decreased supply. Is the price going to get better? No. But is the price going to continue growing at the rate it is? Also, probably no. Many nations, including the US, hold what are called oil reserves. It is an amount of oil that they have stored somewhere that if they ever need it, it's there in case of fire, break glass. It is an oil supply that they can tap into and keep themselves going in the event of exactly this. Changes, significant changes in supply. So as the US and other countries continue to dip into these reserves, in this week they have announced that they will dip into reserves, we are likely going to see these prices flatten out. Now it might seem that when prices flatten, stock prices would flatten too, right? Not exactly. Let's take Facebook as an example. Facebook stock dropped in price significantly in the past few months because we had to realize that Facebook's not growing anymore. The future value that investors thought Facebook had was no longer there. And the price tanked because of it. Right now, a lot of the reason that these companies are worth as much as they are is not because that's what they're really worth. It's because people are thinking the future value is going to be way up there. When prices flatten out, stock prices are likely not going to flatten out. They're going to drop. So let me say this again, just in case it wasn't extremely clear. Energy is extremely risky. We have no idea when stock prices are going to start going down, if they're going to go down at all, but if economics and future value show anything, when oil prices stop going up, these companies are going to drop because their value right now is investors not knowing where the top really is. Once we know where the top is, there's no one buying because they think it's going to go higher. They know it's not going to. There's one last part of all of this that I have not yet mentioned. We've talked about the US market and the European market, but not the Russian market. The reality of it is we have no idea how bad the situation is for Russian oil companies. Russia's economy right now has a lot of question marks because as investors in the US, if we want to say how is the market doing, we just look at the stock market. We look at SPY, we look at sectors. Russia's entire stock market has been closed the entire week and might reopen on Monday. But it's been closed this entire week. So because of this, we don't know how hard oil companies in Russia have been hit. Yesterday, I saw an interview where a newscaster in Russia was interviewing a Russian economist who didn't offer any advice of, I would recommend buying this or this. Instead, he simply toasted to the death of the Russian stock market. Russian economists think that this is going to be the end of the, or at least this person said this is the end of the stock market. We don't know how bad it really is until the market opens and the fat lady sings. We do know some though. Very little, but we know some. Because Russian companies are listed on some foreign exchanges in the form of ADRs. To highlight Gazprom, their ADR in the US, it has lost 87.7% of its value in the last 2 weeks. The ruble, the Russian currency, has gone from around 75 rubles per $1 up to about 125. And let me get the accurate number as of right now. It is at 124 rubles per dollar. Russia's currency is plummeting. Russian oil companies are tanking in value. And the reality is we'll have no idea how bad the case is for the Russian economy until the stock market opens on Monday, if it opens. So now let's try and answer the question, how will this end? If and when the Moscow exchange opens, we'll learn the true extent to the damage of the Russian oil industry. And once we know this, we have no idea how the US market is going to react. But it will likely react. We will learn how the extent of these sanctions, what they have done to one of the biggest economies as far as GDP goes in the world. So could US stock prices go up? Possibly. Could prices go down? Also possibly. The only thing I'm certain of is whichever way it breaks, up or down, it's going to break in a very large way. If we can use one number, let's just look at VIX. An average VIX for a calm market is 15. We are currently at 32, and it has been at 32 for almost the entire, 5 days, but also the entire month. I talked in a previous webinar about how VIX oftentimes spikes. It goes up, but quickly back down. Right now, it's not going back down. It hasn't gone back down for weeks. And as long as this conflict continues to create uncertainty, we will see the VIX remain high. So when the VIX is that high, we can expect for any price changes, any more information to cause the market to react in a very large and unexpected way. The reality is this: we are witnessing the largest war in Europe since World War II, and we have no idea how it's going to end. We are seeing a global superpower be cut off from the world, but the world be cut off from that superpower as well. For better, but much, much, much so for worse. There is no winner in this situation. Could the stock prices go up? Possibly. Could the prices go down? Again, also possibly. But the one thing I am almost certain of is that we're going to see big changes when the changes happen. And that there is absolutely zero certainty of where things are going from here. That is all my opinion of the situation. This is very much a story that we are watching unfold as it happens in real time. Investors are watching all of this happen in real time, and prices are shifting incredibly quickly, just as fast as the news comes in. So I will continue to follow what is going on, both within Ukraine, but also with the sanctions and with stocks. I will continue to try and bring information to you as I find it, and we will continue learning together what this will mean for the future of the energy sector, but also the future of the global economy. There is a lot more at stake here than just the price of oil. There are lives, there's companies, and there is entire nations that are being changed as a result. So, continue to follow, continue to stay tuned, and we'll be back next week with more information as all of this continues to develop, and another way of looking at how all of this is impacting us here in our stock market. So thank you all so much for joining us for today's webinar. If you have any questions or things that you want to see me cover in next week's webinar, you can always email us at support@sectorsmadesimple.com, and we'll see you all very, very soon. Take care, stay safe.